Hello, everybody, and welcome into this week's episode of the Magnify Wealth Podcast. I'm Cameron Gannon, here with my co-host, Scott Gannon. Please make sure you go and like, share, and subscribe before we jump into things. Did you know that billionaires and real estate investors use debt to unlock tax-free cash flow without selling any assets? This episode will uncover these methods and introduce a stable, low-risk option, high cash value, whole life insurance that can be used by all investors and not just the billionaires.
Right, so just a quick overview. So what is tax efficient borrowing and what does it mean? Essentially what it means is if you can use borrowed money instead of redeeming assets or selling something or receiving income from something, then you're going to get it tax-free. Borrowed money is not yours. So what that means is it's not taxable. So it doesn't hit your tax return at all. It works great with the ultra wealthy, the billionaires, and guess what? We can do it too. And again, as Cameron just mentioned, you can do it very conservatively with the use of cash value life insurance, because as we go through all these different ways of accessing this capital, the unique thing about cash value life insurance is it is designed to grow every single day or get larger every single day, guaranteed. It will not fall in value. So let's go into a few of the different methods and
So kick things off. So the first thing the billionaires or the ultra wealthy do to use debt for tax-free cash flow is they borrow against assets. That means they take their assets, stocks, real estate, business assets, whole life insurance, and they borrow using that asset as collateral for the liquidity. What that means is because they have those assets within their portfolio, they're able to access cash, collateralized by those assets without needing to sell off assets to create that liquidity.
Yeah, so it is a double effect. It allows the asset to keep growing as well as not having to trigger a taxable event with that asset.
That takes you on to the next point.
Yeah, and real estate investors, they use that all the time, obviously, for this, but they also use it to finance growth, and they also use it to finance cash flow. And so what that means is, you leverage your existing portfolio to add to the other one. So what that means is you may have an investment portfolio. Let's just say it's worth, whatever, say $5 million. You've been methodically working with that and having income coming from it, but also methodically paying down that debt. And you're at let's just say it's worth $5 million. It may be from growth or from paying down, but now your mortgage is only $2 million. Well, you can refinance that all the way up to essentially conventionally up to $4 million. So potentially, as long as the cash flow will cover it, you'll be able to pull $2 million out. So think of this in terms of you're accessing that $2 million. So what can you do with it? Well, you can move on and invest it into another property, but you can also park it and use it for cash flow for yourself without realizing any tax.
Well, I think a great example too that real estate investors use and how they use this we've talked about before is the BRRRR method. The BRRRR method is a prime example of how you can just build your portfolio by using borrowed money to do so.
Yeah, exactly. Or that's almost like a flip to yourself concept. But yeah, the BRRRR method is the way that this gets done. Now, we haven't really talked about that yet, and we'll get into that in another episode as to what the BRRRR method really is. But it's about adding value, and refinancing is to summarize that. But I'm going to talk a little bit of a personal scenario here as well. So I'm involved with a real estate syndication or apartments, and what we did is I could be getting cash flow, but instead I got borrowed money. How did that work? Well, did a cash out refi, and so I actually withdrew profit from the deal. Well, actually, not just me, everybody involved in the project we were able to pull money out beyond what we invested, so to the tune of about a 30% gain on what I deployed versus what I pulled back out. Now, what has that done? That has caused the cash flow to be significantly lower because there's more debt to pay. But cash flow is, as passive income here in Nova Scotia, in a corporation is taxed over 50%, 52.7. And in high tax brackets, you're still looking at 50 up to 54% tax for income from rents. So yeah, taking borrowed money and a less rent, that works out quite well. That's a tax efficient way to approach your cash flow. It's just about managing the lump sum that you receive.
And I think the final thing we could touch on too with real estate investors is the interest deductibility. So, do you want to touch on interest deductibility?
Yeah, well, so when you invest it in an asset that is designed to produce income, and this could be real estate, it can be stocks with producing dividends or whatever. When you're borrowing to invest, then that's tax deductible. Now, again, we're not tax professionals. You really have to understand what the use of that money is for. When it comes to, like, if you've got an existing portfolio of stocks, that is the actual leverage for the plan. That money coming out needs to be used in a business I guess scenario in order to be deductible. So again, not advocating that it's tax deductible, advocating that you talk to your professional about it.
And that brings us to, like we discussed at the start of the video, is using high cash value whole life insurance as a low risk strategy for your borrowing. So, like, let's start off by letting you guys know, if this is your first time, I'm sure you do know, if it isn't your first time, what is high cash value whole life insurance. So we specially design whole life insurance to be dividend paying and high cash value, meaning it builds a cash value early on that is guaranteed to grow every single day, tax free. That cash value can be leveraged in the same way we're talking about with all these other assets without stunting the growth. The same way you borrow against your property, like we talked about with the real estate investors, it doesn't stop the home from gaining value. Borrowing against cash value in life insurance does not stop that cash value from earning every single day, guaranteed, tax-free.
Multiple use asset, just like the other ones. Now, the unique thing about cash value versus what we call asset backs, being or stocks or whatever, like if a margin account or real estate, all those things can change in value in the wrong way, and that is go down, and that can cause serious problems. So you need to understand the risks that are attached to that when you're leveraging that. Now, when it comes to life insurance, we know it's not going to go down in value, so it will increase in value as Cameron just mentioned every single day. So your collateral is always safe as long as you manage the amount of debt properly. Now, just a quick thing on this though, like when it comes to this, there's a couple of different ways to approach this, and that is when you're doing that through your life as you're actively at work. We always encourage that this is really about planning your tax. And planning, it's just a method of being able to plan how much income you take in every single year so that you can avoid some tax in high income years or whatever. But while you're working, we endeavor to be responsible borrowers and look to manage that either through interest payments or through actually paying it back at some point in time. Again, this is about planning. But once you're beyond when you're financial freedom or retirement, then at that point, this becomes a vehicle where, if structured properly, again, this is all about using the life insurance death benefit at this point, is you can actually just use this money, produce a tax-free income through your retirement, and have the death benefit clean it all up at the end, so to speak.
Yeah, and let's touch on some practical ways we can get tax efficient debt for cash flow. So we'll start off with a home equity line of credit. Okay, so a HELOC can be used to fund your cash flow needs without selling assets in a very efficient manner because it's already applied for and already exists, and you can use it when needed within your real estate endeavors.
Yeah. So there's, and again, this would be something you'd want to really kind of think through. As long as it fits with your budget and your planning, sure, do that. And again, the other things you can do, again, we talked about the real estate, we talked about what's called securities-backed line of credit or margin account. Those are all areas where you can access money tax-free through borrowing. But again, there's those risks are, making sure that those assets that are backing it are solid. And keep an eye on it, because if they do fall, then that's a problem.
Yeah, and we talked about cash out refinancing in your personal scenario. Mm-hmm. And then finally, there's high cash value whole life insurance policy loans, which we discussed in detail. Mm-hmm. So there's some key things to consider and risks to consider when you're using debt for cash flow. First one being volatility. So this is not something with high cash value life insurance because of the guaranteed growth aspect, but when you're dealing with margin accounts and you're dealing with HELOCs as well, if you're in a volatile real estate environment, if the value declines, that could lead to margin calls where you're forced to replenish the liquidity.
Yeah, I mean, again, we've been better that there's a reason why we keep mentioning that, because there are risks attached to that. Again, the Jeff Bezos, the Elon Musks of the world, they do this stuff all the time, but it's not usually like, when you're sitting on, a couple $1 billion of a specific asset and you're going to borrow, 100 million to fund your lifestyle. Kind of funny to say out loud, but for a couple of years, and you're not really at that much risk. But again, it's all about debt to asset ratio. But really, the other thing too is the debt costs and interest rates. Like keep it you should have solid assets involved so that your interest cost is as low as it can possibly be. And again, I talked a little bit about the repayment plan. Not so much as important when you're later in life, if you have it structured properly when it comes to life insurance, but do have a plan in place for it. Either way, whether that be at the end or not. I guess an example of the using high cash value life insurance and real estate. Real estate investors use this all the time. So what they do is they use the cash value of the life insurance as a mechanism. Number one is it is an asset for them when they go to apply to buy the real estate. They can use it to increase the leverage within a specific plan on the way in. They can also use it as a mechanism to they borrow against that, and then they just put cash down, or they just use it as an asset on their balance sheet. There's so many different ways to do it, and again, this is all about flexibility. Real estate and high cash value life insurance, that they work very well together. That's the bottom line. And again, the asset value of it, it's considered cash, and it's always available.
Remember, the key to this episode is to realize that billionaires, real estate investors, and absolutely anyone that is building assets can use tax-efficient debt to manage their cash flow without selling assets and allowing those assets that they do have to continue growing all the time, especially with high cash value life insurance where it's guaranteed to grow every day. It becomes a very low risk and reliable option. So please do remember to like, share, subscribe. Thank you guys for tuning in this week to the Magnify Wealth podcast. We will see you guys next week.
Have a great week, everybody.
Thanks for tuning in to the Magnify Wealth Podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.